All right. Today we got a shortened lecture, again with money markets. Number 2 instrument is Fed funds. And Fed funds is usually a loan from one commercial bank to another commercial bank, usually for the purposes of satisfying minimum required reserves. The loan is usually overnight. Overnight means that the loan is done for 1 day. In other words, it's usually made in the morning and must be paid by the next lunch day. The interest rate is called Fed funds rate. And sometimes we call it the overnight Fed funds rate. This is the interest rate which is paid on overnight Fed funds loan.
Sir,
Yes.
is this rate determined by the central bank or between the commercial bank?
It is determined jointly by the market and is affected by monetary policy. So the market is the main driver, but monetary policy can push it up if they want to push it up, or push it down if they want to push it down. So it's determined by market and monetary policy. We say that it's a monetary policy target. A simple example will be, the target will be, let's say, usually a range. They'll say 0.75% to 1%. That's the target range. If it's inside the range, 0.8, the Fed will do little or nothing. If it starts moving towards 1%, it will begin to intervene. Okay? They will not let it go too far away from the range. So they'll try to make minimum intervention and keep it close or within the range. Okay. Now, these Fed fund loans are considered to be unsecured. Unsecured means no collateral. Next one. Collateral is an asset given in security for a loan. If the loan is not paid back, the lender keeps the collateral. So the collateral is an asset given in or as a security for a loan. If a loan has a collateral, we say that the loan is secured, or we say that the loan is collateralized. To collateralize means to give a collateral in security. So become the loan is collateralized. Okay. Now, with the Treasury, the loan is like considered risk-free. There is a little bit of risk, a risk of one day that you give the loan in the afternoon and tonight or tomorrow morning it will be bankrupt. So there is a tiny little risk that it's going to, that you might not get the loan back the next day. So Fed funds interest rate is just a little bit higher than interest rate on T-bill. In other words, there's a little bit of default risk. It is very, very, very small, but it exists. So interest rate is slightly above, maybe 0.1% above the T-bill interest rate. Let's see. So policy targets, and we have a target range. We also have what is known as a target rates. So it is a Fed policy target rate. Now, in other words, this is a target by the Federal Reserve or Central Bank monetary policy. Okay. The market is highly liquid. Also very highly traded. And the market is very, very flexible. We say in general terms that the market is well developed and very well functioning. But the words well developed doesn't mean much. The meaning is very liquid. Okay, that's the financial meaning. You also have, or it's facilitated by what's called the Fed funds brokers. These are brokers specializing in brokering Fed funds. So sometimes a bank will approach another bank and ask them for a loan. Sometimes they will approach the broker, and the broker will be collecting information from everyone who has available funds and from those who have shortage, and the broker will do the matching. Okay, well, let's do this. It's very little to do, but in general, in finance, in banking, you got the concept of correspondent banks. The general description is that these banks work with, that's the general, not the correct one. They work with each other, they have relationship with each other, so they work more closely with each other. But the technical definition is that they have reciprocal accounts. So if we are two correspondent banks, you will maintain an account with me, and I will maintain an account with you. And if I need extra money, you'll give me some of yours. If you need extra money, I'll give you some of mine. So that's a correspondent banks. Usually, is associated, usually but not always, between a large bank and a lot smaller bank. Will be correspondent banks. So it will be more common to have Fed funds loans between correspondent banks, especially when one has a surplus and one has a deficiency, because they already have the account, they already have established a relationship. So for them, and they already have established a trust, and they've already done the operations. They may have done it hundreds of times, possibly thousands of times. So it's easy and convenient, and possibly cheaper. Let's see what else we got. R, well, that's good enough. Number 3 is repo. Repo stands short for repurchase agreements. Okay. So technically it involves the sale with an agreement to buy back the security on a specific date at a specific price. Technically, economically, financially, the meaning is of a secured loan. And now using the terminology, the loan is collateralized by the sold securities. So you actually get possession and ownership of the security. If in 2 weeks the borrower doesn't pay you back, you already have the security. So these will have very low interest rate because they are very, very low risk. It's very well secure loan. You already have ownership of the securities. Okay, well, it's a little trickier and that needs a simple explanation. Is repo is the sale of the security and buying back. And you may have what's called a reverse repo. You first buy the securities and then you sell them. So, what's the difference between repo and reverse repo? Well, the one thing to understand is that if we do a repo, for the one party it is a repo, for the other party it is always a reverse repo. So, for any transaction, for the one is a repo, for the other one is a reverse repo. So, whether you think of it as repo or reverse, it depends on who initiated the transaction, who needed the transaction. So, it is a little bit arbitrary to say, oh, this transaction is a reverse repo, because every transaction on the one side is always a reverse repo, and on the other is just an ordinary repo. So this name is what we call a misnomer. It's not quite clear. It is clear always for the one side, and it's always the exact opposite for the other side. Now that can be a little confusing. Let's see, usually is 1 to 14 days. Usually is about either 1 week or 2 weeks. If it's one night, it's probably going to go directly into a Fed funds loan. The opposite, if you need 3 days or 7 days, it will not be for 1 week. Nobody's going to do a Fed funds loan for a week. They'll do a repo, usually. So again, depending on how long. If it's 1 day, you probably do a Fed funds. If it's 1 week or 2 weeks, you're probably going to do a repo. Let's see what else. Now, there's a new, well, not now, over the last few years, maybe a decade or two, it has grown to be even 1 to 3 months. So the repo market is the trend is to extend the maturity. Okay, you want 3 months? Sure. Okay, give me your securities as collateral and you can have it. Oh, well, there is something else. You may have a repo which will act as a collateralized Fed funds. Fed funds loan. In other words, if you feel that you're not secure, you can use a repo to, we say, securitize or collateralize the Fed funds loan. That can happen, and that does happen quite often. So the Fed funds is technically unsecured, but you want to secure it. You use a repo to secure the Fed funds loan.
So, can you explain how it works, like to use repo to collateralize the Fed funds?
The repo is basically a secured loan. It's the same as collateralized loan. So instead of me borrowing on the Fed funds from you, what I will do is I will sell you my securities in a repo and maybe 3-day loan or even 1-day loan. Tomorrow we'll reverse the transaction. And the sale itself will give me cash which I need for minimum required reserves. So again, it is technically a loan, well, sorry, not technically, economically, financially, it's a loan from you to me. And it's securitized. I gave you real security, which you can keep if things go wrong tomorrow morning. So it is used, repo is used for the purpose of Fed funds. But if you feel that uncomfortable as a bank to give me, let's say, $100 million, which is a big amount, you'll say, look, I'll give you $100 billion, but you gotta give me some security for it. And we usually structure it as a repo. And again, whether it's 1 million or 100 million, the deal is all the same. Okay, the paperwork is the same, the cost is all the same. So, but the bigger size, the only difference is that the bigger size of the deal, you take bigger risk. So you want to reduce the risk by some sort of security or collateral. Let's see what else we got. Okay, the next little thing is that the Federal Reserve, we can also call it, in the US they call it Federal Reserve, but in general, whether it's Japan or China or Bulgaria, probably Cambodia, you call it the central bank. So the central bank will use repos for monetary policy. So, when the central bank, we say, wants to drain liquidity, to remove liquidity, the central bank will sell the securities for 1 or 2 weeks, okay? And when somebody pays to the Federal Reserve, there are no more funds. The funds are out of the banking system. The opposite is also true. When the bank purchases a security, it pays with fresh cash, and that cash increases liquidity in the banking system. So, thinking from the central bank point of view, when the central bank buys security, it pays with cash to another bank, it increases liquidity in the banking system. So, now we see that the central bank uses Fed funds, in other words, it intervenes in the Fed funds market for monetary policy purposes. Now we see that the Federal Reserve actively participates in the repo market, again for monetary policy purposes. Okay, next one. Number 4. Commercial paper. First of all, it's short term, 1 to 3 months, maybe 6 months. Short term. It's a promissory note. Promissory note is simply that. It's a note that you promise to pay back. The main characteristic is that it is unsecure. It is issued by major corporations. So issuer is corporation. We say corporate issuer. So major corporations will issue commercial paper. Maybe they need extra money to pay taxes. Maybe they need some money to pay salaries. Whatever their reason is, whatever their funding needs are, they will issue commercial paper. The issuer itself will have high credit rating. We say that it's a low risk. In other words, only the best corporations are able to issue commercial paper. Only very famous, very reputable companies we say good or high credit rating. Credit rating is an evaluation of the risk of default for a particular borrower. So it tells you what is the likelihood of default by a particular, we call it issuer or borrower. That's the credit rating.
So, can the credit rating be bought by the company?
The answer is it should not be able to be bought, but in the real world, because the world is corrupt and credit agencies in America are corrupt, it is routinely bought. You pay for your credit rating, and if you pay big money, you get a high credit rating. The credit rating agencies have a protection by monopoly. It's called, if you have one company, it's called monopoly. If it has two companies, it's duopoly. In the United States, you got only 3 companies. It's triopoly. And therefore, by having the protection of the government against any competition, it doesn't matter to these companies how horrible your credit rating is. It doesn't matter if they give the wrong credit rating, because there is no competition. Because if the 3 rating agencies give bad ratings and there is a competition and you always give good credit ratings, we will all go to the one and we'll trust the one that gives good, appropriate credit ratings. And we'll all ignore the 3, okay? But the problem is, by law, she cannot exist. She is not allowed. The law says these are the three and nobody else. And you cannot pay attention to anybody else but these three. By law, you must follow these three. Well, this is the root source of corruption. Now, if one of them was corrupt and the other two were honest, then it's okay. You will ignore the corrupt one and you'll follow the other two that are honest. But the problem is that the second one will make much bigger profit if it becomes corrupt too. And then, hey, it makes sense for the third to get corrupt too, get a lot of money, and we call it boost credit. And now it becomes a race in corruption. Everyone is eager, oh, you pay me that money, I'll give you this rating. The other guy says, no, I'll give you a better rating if you pay me more. So now you got the problem of race of corruption. Everyone offers their services, and here's the best part. It is legal. It is within the law. There is nothing illegal about it. It means 100% legal. That's the best part of corruption. It's in the law. And the second best part is that, well, you gave them a good rating, but they went bankrupt. They cannot sue you. It's not your responsibility. In other words, you can give any rating that you want, but there is no responsibility for it. All right, let's see what else. Oh, we got to finish. We'll continue next time.